Still looking at ethics, still looking at examiner's secrets. This time we're looking at the advocacy threats in more detail. So an advocacy threat is where you become an advocate for your client, i.e. you promote your client's interest in some way. You publicly support them in some way. And that creates a threat because you're no longer objective or independent, are you? So if you're promoting their shares, well, you're no longer objective. If you're representing the client, you're not objective. If you're saying even contingent fees could be attacking your objectivity, and acting like management makes you seem like you're an advocate for them as well. So basically, don't promote the shares. That's one safeguard. For contingent fees, normally you can't get away with contingent fees, as we know, but you could occasionally have fee caps or different teams. But one thing I did want to point out, by the way, you can't promote shares if it's a listed company. There's no way out from that. And you can't have contingent fees if it's a listed company and it's contingent on the audit opinion, or it's just an audit client. You can't have it. So let's go and have a look at the question then, which remember was one of the trickier questions in the exam. So Adventure is the audit client. We've been asked to represent them, or the audit engagement partner has. So the audit engagement partner, should we represent a client? Should we accept this or decline this? We should decline this. We shouldn't be representing them because of the advocacy threat, shouldn't we? And it says there, because it gives rise to, and it gave you 4 choices, an unmanageable advocacy threat. So, okay, question, not too bad. So let's go and have a look at a question now on accountancy that I've made up for you based on this, that I've made slightly trickier. So an audit firm is engaged to provide tax services to a listed client. So listed client, and the client proposes a success fee of 10% of any tax savings. So there's a contingent fee for a listed client. A contingent fee for a listed client, you cannot have them. So the question then goes on to say, but why can't you? What's the primary ethical concern? And that's what makes the question difficult. It's not familiarity. It's not the close collaboration. You might need to collaborate closely, but it's not the familiarity threat. It's not an intimidation threat to try and reduce fees because it's a success fee. And it's not a self-review threat at all, is it? It's actually an advocacy threat where the fee structure incentivizes you to maybe not perform your tax advisory services as well as you otherwise might. So let's just have a look at the explanation. It says contingent fees are tied to tax outcomes, create an advocacy threat, okay? Incentivizing the auditor to prioritize the client gains over impartiality. So that's what it is. And the ACCA code prohibits contingent fees for audit clients to prevent this bias. It's not a self-review threat because these only arise when auditors audit their own work, like preparing financial statements, not tax advice. And it's not familiarity or intimidation because that's not the primary issue here, okay? The primary issue was advocacy threat. And the key takeaway, advocacy threats often involve financial incentives for auditors to act as client advocates. So that's what you're looking for in an exam.